Hello, everyone, and welcome. Thank you so much for joining us today. You are here with the Bid Ready series. So in partnership with ESD's GoSemi and the Division of Minority and Women's Business Development Offices, we aim to provide resources to get firms contract ready. And today we have Surety Bond Associates with us, and they're going to be presenting on construction accounting and choosing the right CPA. Surety Bond Associates is doing a series with us. So we will let you know when the next one is, which is actually just in 2 weeks on the 19th. So you can register for that as well. All right. So our agenda for today is following our welcome. We'll talk a little bit about what Bid Ready is, and we will have a presentation from Surety Bond Associates. And then just to note that this is the second in their 6-part series. So they will be back with us in 2 weeks and then again in September. So after that, we will have a Q&A session. We have some questions that some of you have already asked through registration, and then you also have a Q&A feature here where you can add a question at any time. After Q&A, we will share just a couple of announcements, and then we will close. So just a note before I talk about Bid Ready series, our chat feature is off today, but if you're having any issues or have a question, please message the moderator or ESD facilitator. By entering the room today, you are agreeing to be recorded and you agree to be courteous to all individuals in this room. As a reminder, please be sure to change your display name to your first and last name, especially if you are entering using a phone. Please note the views presented in today's webinar are those of the speaker and do not necessarily represent the views of ESD or the New York State government. Okay, so the Bid Ready series is aimed at supporting small businesses, MWBEs, and SDVOBs become bid ready as New York enters a massive era of development. There are many requirements needed to be successful on a large-scale project. Bid Ready bridges the resource gap. Join us as we provide resources to demystify what can be a complex process, facilitate conversations with experienced prime contractors, and answer your questions. Joining us today are representatives from ESD's Division of Minority and Women's Business Development team. They're here to help you navigate these challenges. Please feel free to reach out to them individually after our event today. So ESD has many resources to help you and your business become prepared to work on larger contracts. We are here to support you. The links to all of these resources are found on the bottom of our Bid Ready webpage, but I'll just go over a couple of them very quickly. If you don't already know about Capital Access Program, it's a loan loss portfolio insurance program designed to increase financing opportunities. We have entrepreneurship assistance centers throughout the state that provide instruction, training, technical assistance, and support services. We also have small business development centers that provide no-cost, confidential, one-on-one business advisement, training, and research. There is a manufacturing extension program, which focuses on small and mid-sized manufacturers that provide growth and innovation services and helps create and retain jobs, increase profits, save time and money. One of our partners for the Bid Ready series is GoSemi. This is the Governor's Office on Semiconductor Expansion, Management, and Integration. There's a lot of development happening in central New York specifically, and there are many projects underway and upcoming, so stay tuned to the Bid Ready series for more information and events down the line. Okay, before we get started with our main event today, we have a couple of events we wanted to let you know of. These are all on our webpage. So upcoming Bid Ready live webinars will be on August 18th. AECOM Tishman will come on and talk about the Bally's Casino in the Bronx. And SBA will come on again the next day on the 19th to talk about how surety companies use financial statements and work in progress reports. We also have the New York State pop-up series is coming to Western New York on September 17th. Registration is required, so keep an eye out for that. And Chips and Bricks is a regional opportunities expo coming to Syracuse on August 25th. Registration is also required for that, so keep an eye. All right, I'm going to stop sharing and I will pass to Brendan, who is our facilitator today, to introduce themselves and today's guest.
Hey, good afternoon, everyone. My name is Brendan Regan. I'm Director of Contract Participation with the division. Just to remind everyone, I'll be facilitating the Q&A later in the presentation. So please, if you have any questions, make sure you type them in the Q&A as the chat feature has been disabled. And without further ado, I'll introduce Ellen Nalen from Surety Bond Associates, who will provide a presentation on their firm and how to be a successful bid partner. Ellen, all yours.
Thank you, Brandon. Let me get my presentation up here for everyone. Okay, thank you for joining us today. My name is Ellen Nalen. I'm the owner of Surety Bond Associates, and we've been hired by Empire State Development through a $500 million grant that they received through the American Rescue Plan Act that's being administered by the Department of Treasury to run a technical assistance program related to their New York State Surety Bond Assistance Program. And we've been fortunate enough to be invited to participate in a webinar series with the Bid Ready team, and we're very excited to be here. This program is really meant for all small businesses across New York State through the State Small Business Credit Initiative, or SSBCI, and the program actually falls under the Capital Access Program. And it provides funding to support programs for small businesses, including socially and economically disadvantaged owned or SETI owned businesses and very small businesses. And I'll get into the definition at the end of our presentation on what some of that language means. And with this funding, Empire State Development has developed a suite of capital access and equity programs available to New York State small businesses to help them recover from the economic effects of COVID-19 pandemic and allow them to build capacity and get access to some of these public uh, opportunities. And through our partnership with Empire State Development, Surety Bond Associates provides financial, accounting, legal, and technical assistance to help contractors successfully secure surety bonds, which are a resource and a financial product that are needed in order to bid on public funded projects that include contracts from cities, towns, villages, counties, state and federal and public authorities, and some of the very large projects that have capital investment from the government, like the Go Semi project. Through this program, eligible contractors can receive a guarantee of up to 30% on their bonding to enhance their ability to get bonding. Today is our second workshop in our six-part series, and we do focus a lot on construction accounting and financial management. These are main barriers that small contractors face when they're trying to access financial resources that they need to compete and grow their business. And construction accounting is a very specialized form of accounting. Construction business owners regularly have to submit financial reports to bonding companies, banks, and for wage compliance purposes on government contracts. And it's important that the owners have an understanding of accurate job cost accounting in order to submit timely and accurate reports. And accounting for the construction industry requires a very unique form of bookkeeping and financial management that many CPAs aren't really that familiar with. And it's designed specially to help contractors keep each job, keep track of each job using the percentage of completion method of accounting. In today's workshop, our CPA partner, Diane Daly, is going to review the nuances of construction accounting and work in progress reports to determine a contractor's bonding capacity. Diane, I'd like to turn things over to you now.
Thank you. And Ellen, can you hear me?
Yes.
Okay, I just wanted to make sure. Okay, as Ellen just stated, it is very important for construction accounting and job costing. I have just picked up a new client and we are trying to get just 2026 job costed. I know we're already in August, but it has been a nightmare, but we are getting there. So we are going to go over a little bit today about how important it is for the construction accounting, and you need a construction accounting accountant. So today we're going to go over the construction industry profile, construction accounting overview, recognition basics, which makes you different than all other industries, and what sureties look for. So the trends, we have rising insurance cost, critical marketing, uncertain healthcare reforms, increased and reported backlogs, and technology. So rising insurance cost. I just got off the phone with a client. They are being sued left and right from people just falling outside of their job sites. So their insurance costs are tremendous, and they might actually start another company to move some operations over there to help their insurance costs. So anything that you can do to help with insurance cost is great. Critical marketing. You need to get your face out there. You need to let people know that you exist and that you would like to work with them. Even if you're a smaller electrician and you want to work for like a nationwide electrical firm, that's fine. I have a client that is actually doing that right now, and it's working tremendously to his favor. Uncertain healthcare reforms. With if you are not union and you can control your healthcare costs, I mean, if you have key employees, you need to hold on to them. But if you could pass some of that cost on to your employees, it may not be a bad idea. Reported backlogs. There is an increase a little bit in reported backlogs. I do have a couple clients that are very busy, but they are the ones that are really getting out there and marketing themselves. And technology. You need to keep up with technology because as you grow, you may need to do billing or certain things on different programs, like if you're like Procore and things like that. So you need to be well versed in technology, including accounting software, in order to run your back office correctly. So your top 6 challenges. Sources of future work. I tell my clients all the time, you're only as good as your next contract. Healthcare insurance costs. Like I said, if you can anyway pass on some of the healthcare costs to your employee, if you're not union, that's a great way to help save yourself money. Shortage of trained field help and shortage of trained project managers. I'll go through both of these at the same time. I am really starting to hear this more often. I have a client that they just switched to union because they just can't get employees. I don't know that switching to union was a good thing, but it is helping their industry just because their costs are going to go up so high because they just converted to union. But if you have key employees and trained field help and project managers, people are going to try to steal them. Do whatever you can to keep them in your company. If you are providing part health insurance and you're not covering full, maybe you say to them, look, I'll pay all your health insurance, I'll give you a raise, because not everybody is replaceable. Price escalations. We are seeing this a lot with the tariffs. Please make sure, if possible, you can have escalation clauses in your contracts. This way, if some type of material, like right now, lumber, may be higher than normal because of the tariffs in Canada. So, if you can put price escalations in your contracts, that's a great idea. And material shortage. That's kind of making its way back from COVID, but I do know that people are still having problems getting some material. Like they have to order it 6 to 12 weeks out, depending on where it's coming from. So you have your types of contracts. You have your fixed price hard bid. That means you give a price, you bid it, that's your contract if you're awarded the job. Fixed price negotiated. That's typically if you're working for a general contractor or you're bidding to a general contractor. Typically, what happens is you bid your price to the GC. The GC wins the job. They come back and they say to you, hey, what can you do to, reduce your price a little bit so that we can use you? So make sure that you mark your price up a little bit higher, just if you know that's coming. Gross maximum price, I really don't see this, but there is that type of contract out there. Unit price, that is if you're like a concrete contractor. You pour a certain concrete, the either township or the owner comes out, measures it, that's what you get paid for. Whether you invoice additional money or don't invoice enough, they're going to adjust your bill to what work you have completed. Time and materials, best profit margins typically. That's great work to get into. Cost plus fee. You have a good cost, and then you get to charge a fee on top of that. And then construction management. This is another very good profitable area to get into because you have no risk. You aren't even performing on the job. What you are doing is you are overseeing actually the GC and all the subcontractors because you have a specialty in that type of work. The owner knows it. So they know that you have a reputation of finishing your jobs, but unfortunately you didn't get the job or maybe you didn't even bid it. So they will hire you as a construction manager and all you do, you go out for meetings, you just make sure that the job is progressing as it's supposed to be. You go back to report to the owner and you get to charge a fee. And a lot of times if the job comes in less than where they were expecting, you can get even more of a fee for that. So construction management it's a hard area to get into, but it's a very profitable area. So successful firms build networks. It is key. I mean, even building your network within your team is key. And I hear a lot of times, you don't hear from your accountant. You don't hear from this person. Well, your accountant should be very involved in your business, especially if you're growing, and they should be the quarterback for everybody underneath you, your banker, your surety company, your surety, your insurance company. That's part of your network. Your back office is just as important as out in the field. Retain key employees, as I said, even in the back office. Sometimes that can be very important, just as out in the field. Manage your risk. If you are doing something good and you have a niche in a certain field, stick to it. And that kind of falls in line with do what we do better strategy. So if you want to go and try a new field or a new area of like carpentry or something like that, what you want to do is test the waters a little bit. You don't want to, go out and get a $2 million job of something that you have no idea what you're doing because I'm going to tell you you're going to lose money. Seen it happen many a times. Volume kills, profit thrills. I hear all the time, oh, I billed $2 million of work this month. Well, that's great. Did you make any money on that $2 million? I don't care about your top line. I care about your bottom line because you could have billed $2 million, but your direct cost could have been 2.1. So you're actually showing $100,000 in negative gross profit. So that's not covering any of your overhead. So it's not about what you're billing. It's about what you're making on the job. And then high priority on safety. If you do have a team out in the field, there are things that you could do. You could have safety meetings on a weekly basis. You could put tool tips into their paychecks. It will help you with your maybe your general liability rate and also your workers' comp rate. Now, if you keep having accidents on a job, that's not going to help your workers' comp. But, anything you can do to help reduce your insurance costs is not a bad idea. So your construction accounting overview. This is kind of the debits, credits, and the accounts that you will be using, the account process, financial statements, and job costing. That's what we're going through next. So the debits and credits, they are the building blocks of accounting. That's what I do. So you have your types of accounts. You have your assets accounts. And these to me are things that you own, okay? Your cash, your checking account, whatever's in there, that's yours. You might have payables to pay, but hopefully you'll have accounts receivable. Receivables are for work that you've completed and what you've billed your customer for. Inventory. Try to keep minimal inventory if possible, but I will say I have noticed some of my clients, if they do know that a tariff is coming up on a certain piece of a material, they will buy it in advance and just keep it either in their shop or in their yard so that they don't get incurred with the additional cost. Your property and equipment. These are things that you have purchased, that you own. Your trucks, your backhoes, your things like that, your vehicles, and your contract assets. This was really be what we would call cost in excess of billings. So we'll get into that in a little bit. Then your capital accounts. You have your common stock. That would be an S corp, and retained earnings would be an S corp. You also could have member equity, which everybody is pretty much an LLC now. But just so you know, you can be an LLC taxed as an S corp or a C corp. I would talk to your accountant about that if you are not and see what they advise you to do. Then you have your liability accounts. These are things that you owe out. You owe people for work, like your subcontractors, your materials, that's your accounts payable. Your notes payable, that's your notes on like your vehicles and your equipment that you purchased. Your retention payable, that's your 10% that you're withholding on your subs so that because you're having 10% withheld from the owner. So you don't want to withhold, you don't want to pay your subs in full. You want to withhold the same retention that you're being withheld because you're not getting that money back if you pay in advance. And then your withholdings, your payroll withholdings, your union withholdings if you're union, or if you have a retirement account, your 401k withholdings, and then your contract liabilities. This would be called your billings in excess, and this means that you have billed more than you actually have incurred in costs. Now you have your expense accounts, your cost of earned revenues. That's any direct expense, anything associated with making this pencil. If you are a professional service, you would also have indirect expenses. You want to keep those separate because you can bill for those. General and administrative expenses, that's all your back office. I know a lot of owners out there don't think the back office is important, but I'm telling you right now, if you don't have a good back office, you are never going to know how well your company is operating. I'm telling you, I'm dealing with it right now with the new client that I picked up. The one bookkeeper I'm kind of evaluating right now because I don't really like her responses when I tell her something. Her response would be, instead of saying to me, you know what, I'm a little overwhelmed right now, I don't know that I can get to that. Her response right off the bat is, well, I'm not going back and doing that. Well, it's going to help us be able to prepare a whip. So somebody has to do this. So I told the owner, if you pay me to do it, it's going to be very expensive. So you want to make sure that you have good people in your back office because I'm telling you, they are just as important as the people out in the field. And then your interest expense, that would be if you have a line of credit or if you're paying on vehicles or equipment. Then you have your revenue accounts. Contract revenues, that keeps track of your billing throughout the year. And then your interest income. If you do have some excess money, I would maybe put it in a money market to maybe earn some interest. I have some clients that are earning some pretty good interest. The 6-month statement I just did, they've already earned $12,000 in interest income for the year. Not too shabby. CDs you want to watch though, because you don't want to put it in a long-term CD in case you need it. If you do have that idea of doing a CD, short-term, 3 months tops. So this is universal in accounting. It's the first number in the number series. I don't care about the 3 numbers after it. but your first number is what all accountants use. If you have QuickBooks and you have a chart of accounts that they automatically assign, guess what? This is the numbering system that they use. So as we just said, we went through all these classifications, but your number that should go with these classifications is your ones, your thousands, that should always be your assets. Your twos, your 2000s, that should always be your liabilities. Anything that starts with a 3 would be your equity. That keeps track of your profit and loss throughout the year, less any money that you've taken out. Your 4s are your revenue, and that keeps track of all your billing throughout the year. Your 5s would be your cost of earned revenues. Again, anything associated with making this pencil. So now, contractors and specialty contractors, just hold off for a minute because I know there may be some professional services in here. Your 6s would be your indirect expenses because they do need to be broken out separately, because if you do try to go get certified by a certain entity, sometimes you do have to supply your chart of accounts because they want to know that your accounting system is set up correctly. So then your 6s would be your indirect, your 7s would be your overhead, and then your 8 and 9s would be your indirect, your miscellaneous expenses like gain on sale of equipment, loss on sale of equipment. Interest income, interest expense. Now, GCs and specialty contractors, your 5s would be your overhead, your direct expenses. Your 6s would be your back office expenses. And then your 7, 8s, or 9s could be your other miscellaneous accounts. So now, typically, a lot of you have a program that does this in the background, and you just post the entries in there. But we're trying to teach you as much as possible about the accounting process. So your invoices, these are things that you have to pay. They go to your AP journal. Your checks, things that you're paying your AP with, they go to your cash disbursements journal. Your time cards, the things that your employees are filling out, they go to the payroll journal. Your billings, things that you're billing to your customers for you to get paid, that goes to your sales journal. And then when you get paid on your billings, they are considered cash receipts, and they go to your cash receipts journal. And then all of these journals dump into a general ledger and a subsidiary ledger. So your subsidiary ledgers, for example, would be like for all your customers, you should have like an accounts receivable aging summary or aging detail that you are able to call on once a week to find out where your money's at. Same thing with your accounts payable. You should have an unpaid bills detail or an AP aging summary that you're able to use on a weekly basis to pay your bills. And note the total of those two journals will tie to your total on your general ledger. So all of this summarizes into your general ledger, and your general ledger is what your accountant would be using in order to prepare your financial statements. So to reconcile your accounts, you have AP journal plus your sales journal plus your cash receipts journal plus your cash disbursements journal plus your payroll journal equals your general ledger and your subsidiary ledger. And they must always agree. So when you get to the point, now you're going to get to where you're preparing financial statements. So all companies have balance sheets, statement of operations and retained earnings, and statement of cash flows. So your balance sheet is your assets equal your liabilities and plus your equity. So you're going to have two different sections on your balance sheet. The top part's going to be your assets. The bottom part's going to be your liabilities and equity. Those totals need to agree. Your statement of operations and retained earnings. Your revenue minus your expenses equals your profits. Now I'm going to tell you something. Yes, you do want to be profitable, and you do want to show profits, but there may be years, where you have a problem job or something where you may show a loss. But it's really your balance sheet that you really want to concentrate on, because your balance sheet is what's going to keep you in existence if we ever do go into a recession. If you have a strong balance sheet, you will be able to continue to pay yourselves and keep whoever employees you have on there because you kept the money into the company and you were being conservative on your back office and keeping costs, minimal. So the balance sheet is what's key. I don't care what industry you're in, the balance sheet is always, to me, the most important statement in your financial statement. So your retained earnings or members' equity, that shows your changes in stockholders' equity for the year. It's pretty much the beginning of time, your profit and loss, less any draws you've taken out. Your statement of cash flows, shows your cash from operations, cash from investing activities, and cash from financing activities. You always want your cash from operations being positive. You don't want that to be a negative number and your cash from financing activities being a positive number. Because what that tells me, the bonding company and the bank, that you're operating your company on debt. You don't want that. You always want to be able to have positive cash flow on your operations. And your cash from investing activities, that's if you put money into the company or you buy equipment. That's what would show up in that area. Now, your supplemental schedules, your cost of earned revenues, your general administrative expenses, they're going to be in every financial statement. What makes you different from all other industries is the earnings from contracts, completed contracts, and your contracts in progress schedule. This is what your bonding agent is going to use to analyze to see what your bonding capacity is. You always need to be conservative on your contracts in progress schedule so that you don't show profit fade on your completed contract schedule. And your earnings from contracts is literally a tie-in of your completed contracts and your contracts in progress. And then that schedule ties to your statement of operations. So job cost, what is it? What isn't it? So your detail accounts, you have your labor, materials, equipment, your subcontractors, and indirect costs. You have your types of job costs, direct costs and indirect costs. So your direct cost, you have your materials. And honestly, I used to say your materials, you can control that cost, but any more, ever since COVID, between the material shortages and the tariffs, I don't know how you're estimating that. That's why I say put an escalation clause in there. Your labor, that's something that you can control, and your labor can make or break a job depending on how large the job is. I always tell my clients, don't take a job that you can't control. My one client, every time he took a building that was 30 built floors, lost his shirt. I mean, it was just sad. Lost his shirt. He finally got the concept, and now he's only doing buildings over 5 floors. But you just have to do what you do better. Your subcontractors, that's people that you're employing to work under you, and that's good because that can control your profit. And then your equipment, rentals and installed. So your installed equipment would be, let's say you're an HVAC contractor, you have to put a huge unit on top of a building, let's say the Empire State Building, that would be installed equipment. Your rental equipment, keep in mind, if you have a job that needs a specialized piece of equipment, please do not purchase that piece of equipment because it's going to sit in your yard after the job. You're most likely not going to be able to sell it. And then you're going to most likely be making payments on it and insurance. Only buy the equipment if it's absolutely needed and you can use it on continuous jobs. Do not purchase equipment that's going to sit in your yard year after year after year. You're going to lose money on it. Now, your indirect cost, you would have indirect labor. There's people that are working in your shop, like maybe pulling materials for, the jobs for the next day. Tools and consumables. I hear this all the time. I bought a bandsaw. What do I charge that job to? I'm like, just throw it in an indirect expense. And if we have a little unallocated, it's not that big of a deal. But if there's a large amount in that account, then I'm going to break it out over the jobs, spread it out. Same thing with insurances. Very hard to job cost, but I actually allocate that over the jobs based on the cost throughout the year. And then your owned equipment cost. Typically, you need to keep track of that if you have a lot of equipment, like if you're a heavy highway contractor. I do have a client that we have assessed they are a heavy highway contractor. I have two of them, but one is going out of business. They're just closing up shop because guess why? They can't get any field help. So they're just done. They have another company that's doing very well. They don't need the construction company anymore. But your owned equipment cost, if you do have a lot of equipment, you do need to figure out an hourly rate so that can also get charged to the job. So now your job costs exclude your back office expenses, your G&A, your selling expenses, anybody out there marketing to get you work, your pre-contract costs. This always also includes the cost of estimating the job. I don't care if you're awarded the job or not. That is not job costed. You were going to bid that job, whether you were going to get it or not. So it does not get job costed. Now, oh, revenue recognition. So this is what makes you different than any other industry. And this is very confusing to a lot of people, but I have been going into certain, a lot of my clients do understand it. The others that don't, I go in on a monthly basis or bi-monthly basis and we do this schedule and we go through it until they do understand it because this could make or break your bottom line. So you have your gap methods, what sureties look for, your calculations, your cost in excess, billings in excess, and work in progress. So your gap methods. So you have your cash basis. Income includes all money actually or constructively received. That means just money that you've received, not your receivables. And expenses deducted when actually paid. So it doesn't include your accounts payable. It only includes what you've actually paid. No bonding agent or surety is going to accept this method. This is a good method for being for tax basis because the cash basis doesn't really give you a true picture of what your company is like. Then you have accrual basis. This is a little bit better. So income recognized when the product or service is provided. So it includes your accounts receivable, money that you're waiting for, and expenses deducted when occurred. Also includes your accounts payable and what you paid. Also, you cannot present a bonding agent is not going to accept a financial statement on accrual basis because it doesn't have a percent complete adjustment in there. Also, not a good way of being taxed. Not. Cash basis, yes. Completed contracts, yes. So completed contracts, income and expenses recognized when contract is completed and accepted by customer. Next slide. And recognizes revenue after the project has been completed. Why would you ever want to do a financial statement that only shows profit for jobs that are completed? You have all this other work in progress. Why wouldn't you want to pick up that profit? Again, though, this is a very good method of being taxed. Completed contract methods, I honestly did one of those financial statements when I first came out of college. And that's way back when. So I haven't seen one of those statements in ages. Percentage of completion. This is what you guys need to provide, even if you're a professional service. Because if you're a professional service and you can't bill in full for the work that you have completed at the end of the month, that means you have to do a work in progress schedule. So the percentage of completion method recognizes revenue as work progresses. So most users of financial statements, and especially a surety, they expect the use of percent complete. To me, it's the only way you can actually do a financial statement if you're in construction. There is no other way. So here's an example of what we're talking about. I call this matching apples with apples. So computing earned revenue using percent complete method. So your contract value is $100,000. Your total estimated costs are 90. Your cost to date are 45,000. So your estimated costs are 90, your cost to date are 45. And your bill to date is 60. So your earned revenue equals the cost to date, the 45,000 divided by the estimated cost of 90 multiplied by the contract value. So $45,000 divided by the 90, you're 50% complete, multiplied by $100,000 means that you've actually earned $50,000 on this job. So you've earned 50, your cost of construction to date is 45,000, so your gross profit, the profit that you've made on this particular job is $5,000. So the work in progress schedule, your WIP, it shows what your expected profit is. Usually included with contractor financial statements as a supplemental schedule, shows which stage jobs are in. So you have your overbillings or underbillings. They arise from percent complete method, difference between amounts billed and revenue earned, basic calculation required disclosure on financial statements. So here's where I'll get into this a little bit. So we already said we had 100,000 contract value. Estimated cost to complete is 90. Our estimated profit is $10,000. We've earned 50,000 because our cost to date are 45,000. So 45 divided by the 90 is 50% multiplied by the 100 gives us our earned revenue. So our recognized gross profit is 50, but we've billed 60. So if you don't do this schedule, right, you've only earned 50, but you billed 60. That means you're recognizing $10,000 more in profit that you haven't earned yet. So if you don't do this schedule, you are not going to get accurate numbers. So you have to pull out your overbilling of $10,000. That's why it's critical to do this schedule. So overbillings, also called billings in excess of cost and estimated earnings. So your BIE is billings in excess. So is what the billings in excess means. It is a source of financing because you're ahead of the game. You're ahead of the game on the work you have completed. You want to make sure that you have that cash. If you've been paid, you don't want to start using that cash to pay for other work. You want to make sure maybe you separate it into a different account and you hold on to it until you need it on that one particular job. Smart billing practices. You're doing your billing timely. It's so key. Cash flow is key. Unrecognizing vendor liability, sub. So if you're a general contractor, even sometimes a specialty contractor, if you have subcontractors, if you know that you've done the work, you're going to bill for that, whether you have the sub bill or not. You know what's done on the job. You're going to bill for that. So if the sub hasn't billed you yet, you are going to be overbilled for that reason. And then decreased risk. So meaning that you're ahead on the on your client, on your customer. So, at the end, you might only be owed a small balance, so they can only withhold if there's issues on the job. The other thing overbillings may be you're actually making more money on the job than you actually bid it for. That usually goes by labor hours. If you can beat your labor hours, that's when you're going to make your money. So underbillings, also called cost and estimated earnings in excess of billings. Your cost in excess, your CIE equals cost in excess. I will tell you, I don't even like seeing underbillings on jobs unless the job just started and it hasn't been able to be billed yet. It's the only time I don't like, I like to see underbillings. So it's a drain on cash flow. I mean, you're not doing your billing right, so you're not going to get paid timely. And remember, in construction, sometimes you're waiting 60, 90, 120 days to be paid. So you need to do your billing. Over recognized earnings, meaning you're saying you're making 15% on that job, but you're not. You're actually only making 10. Poor billing practices. You're not doing your billing timely. And increased financial risk. So you're behind on the owner. So guess what? At the end of the job, they owe you a bunch of money. Guess who has the upper hand? They do, because you need to now, you've done the work. So now you need to go out and try to collect that money. So, and you also want to be conservative. You don't want to show underbillings, because if you are constantly showing over recognized earnings, the bonding agent and the surety are going to figure that out, and they're not going to believe your numbers on your financial statement. So that's why this schedule is so key to understand. So rules of thumb. So your bonding capacity is your 10 to times 20 times your working capital, 50% for a single limit. Your working capital equals current assets minus current liabilities, and they will actually look at that, analyze it, and they may discount that working capital depending on the situation of your financial statement. And 5 to 10 times net equity. If you don't have a strong working capital, they'll use this method. But as you can see, you'll get like a lower multiple for 50% for a single limit. So your working capital, current assets minus current liabilities. So 5 million minus 4 million equals $1 million. That's your working capital. So now if you don't have strong working capital, what they'll look at is your debt to net worth. So you have total debt of 4.5 million and total net worth of 1.5 million. So look at how your bonding capacity gets calculated out. So your working capital, 10 to 20 times a million, you get 10 to 20 million dollars in bonding capacity. But look at it on your debt to net worth. Yes, your 1.5 is a higher number, but guess what? Your multiple is lower. So 5 to 10 times on 1.5 million equals 7.5 million to 15 million. So that's why the working capital, and as I said earlier, strong balance sheet will help increase your working capital and increase your bonding capacity. I'm telling you, I have seen clients who have had a loss. The bonding companies are like, okay, why is the loss? You explain it, but your balance sheet is strong. They're not going to discount most likely it's not going to affect your bonding capacity, because your balance sheet is able to absorb that loss because it's so strong.
And oftentimes that can be a timing issue. And through this program, Diane will be teaching a full day QuickBooks for construction accounting clinic in October. I believe it's October 22nd. And all of you are welcome to participate in that. Now I'd like to close things with just a brief review of the Surety Bond Assistance Program through Empire State Development. Through this program, it's really meant to eliminate some of the financial barriers, like you don't have the working capital that surety companies want, or you're not profitable. And through the assistance offered through this program, we can eliminate some of those barriers that prevent contractors from accessing bonding and other financial resources they need to compete. And if you're a New York State socially and economically disadvantaged individual-owned business, and that definition includes any business that's owned or controlled by individuals whose access to credit has been diminished due to factors like racial or ethnic prejudice, gender, disability, or even rural residency. And this does include certified MWBE firms and certified veteran-owned firms, but you don't have to be certified to be eligible for the benefits. offered through this program. You can also be a very small business, and that is any business with less than 10 employees. You're participating already in our workshop series, and it's really geared towards being prepared for surety bonding so that you can be bid ready to bid on state, local, and any other government agency contract. We do place an emphasis on helping you get your construction accounting systems and back office systems in shape. We have the QuickBooks Clinic, as I mentioned. We do have a construction attorney on our team, along with a construction insurance and financial specialists. Those workshops will be coming up to round out our 6-part series. You also get access to free one-on-one technical assistance through our subject matter experts like Diane. She can help you set up your QuickBooks system. She can help you with your financial reporting. We have surety bond advisors, myself and Jocelyn and Denise in our office can help you with your bond applications. We have an expert that is a back office expert that can help you with in other areas of financial management. Our construction attorney can help review contracts and subcontract agreements and help you deal with dispute resolutions and things of that nature. And finally, our construction insurance specialist can provide you with assistance in getting the proper insurance policies in place. It's getting very difficult to get for construction companies to get insurance in New York. We also can offer access to capital. Empire State Development has a New York State contract financing program, and we partner with one of those providers who will be leading our financial management workshop that is coming up. And last but not least, Empire State Development, through our relationship with them, offers up to a 30% surety bond guarantee, which allows us to relax some of the underwriting requirements that surety companies are looking for from contractors to get bonding. Our surety bond advisory service will help you with your bond application, help you gather all the supporting documents that become part of that bond application. We provide you with access to the New York State Surety Bond Assistance Program and other financial assistance programs to help you get qualified for bonding. And we also help you develop strategies to either obtain bonding in the future if you don't quite qualify for it now, or to help you increase your current bonding capacity. To be eligible for the free technical assistance and the 30% guarantee from Empire State Development, you have to be a New York State SETI or very small business. Your business should be in business for at least 2 years. Your maximum bond program is generally limited to $2 million, although we recently got one approved last week for an aggregate of $3 million. Your minimum average gross revenue should be around $400,000, and maximum gross revenues shouldn't exceed $5 million. They're looking for a minimum credit score of 600, and you have to provide evidence that you have experience completing similar work to the contract that you're pursuing. So if you're interested in receiving any of this free one-on-one technical assistance or to get access to any of our resources, you can reach out to Pam Durkin. Here's her email address, and you'll get a copy of this presentation when you leave the webinar today. Thank you, everyone, for joining us. I'm going to stop sharing our screen so that Empire State Development can wrap things up.
Great, thank you. We do have some pre-submitted questions, and we do have one question in the Q&A. Before I go to the Q&A question, though, I just wanted to double check with the person who submitted it. I believe they were referring to the revenue recognition under billings, over billings. So I just want to make sure that's the case before we address that question. So if you're the person who put that Q&A in, please go ahead and just, confirm that's what you were referencing. So we do have some pre-submitted questions. Our first one, not really construction related, but they did want to know, what is the amount of bonding a security guard company needs?
Well, it depends on whether you're looking for the standard license bond to get licensed as a surety or as a security guard. That is a $10,000 requirement required by the state. And then if you are bidding on some government work, that contract itself might need bonding, and that would be based on the contract price.
Okay, great. Another question we had was, someone was preparing a construction estimate for a project they're looking to bid on, and they wanted to know, how do they go about determining what their overhead would be? What kind of suggestions do you have for them?
Well, my first suggestion is having an accurate job cost accounting system in place. Diane started to discuss what that looks like today. Certainly having a relationship with an accounting specialist that is familiar with construction, you need to understand your numbers before you can really put together any estimate that is going to help you cover your job costs and earn a profit so that you can pay your overhead and general expenses. So take our QuickBooks clinic that's coming up.
Yes.
Great advice. Third question is very general. It says, I'm new to this and learning, and I want to win bids. Will this be the best stop for me? I think we all agree, yes. Bid Ready is the place to go. You'll learn everything from surety bonds to navigating the New York State contract system. So I think this is a great, program to join in on the SBA, because you'll have 6, total that will teach you just about everything you could think of when you're going for those surety bonds. So yes.
And you get free technical assistance from experts that you don't have relationships with now that you really should, to round out your team.
Great advice. And so our one Q&A in the system, the person would like to know, should you do revenue recognition, under billing, over billing, review with every project before you start submitting additional bids?
I think that's for you, Diane.
Yes, my opinion is yes. You need to do it. It's not just for preparing a bid. You need to do it to see where you're progressing on the job. Like, you want to make sure that the job is progressing the way it's supposed to. So if you do that schedule and you're analyzing it, then that way okay, I'm profitable on these jobs. I will have the money, to front load these other jobs for me to bid on. So yes, you have to do that underbilling, overbilling on all work. If they're maintenance jobs, I don't typically throw those on the whip. Just typically your large jobs, because maintenance jobs, you typically, once it's done, you can bill for it. So that's.
And our upcoming webinar in 2 weeks really digs into the balance sheet and the work in progress report, and helps really tie together everything that Diane reviewed today.
Sure. Just a question I have. I know we talked about, the rising of insurance costs and making sure, you're lowering your risks on that. Is there anything, that a vendor could do that could help reduce those costs? Is there anything like the 8-hour driver course for OSHA to reduce, premium costs?
I do know, like, for a fact, my one client, what he did every week was he went on, and there's this tooltips thing you can print out. He would put them in every paycheck. The problem is, it's really about what happens in the field. If you have somebody that's accident prone, forget it. I mean, but what I will tell you, what my one client does, he will not turn it into workers' compensation. Depending on what the injury is, he'll tell them, go to the hospital, let's see what the problem is before we turn it into workers' compensation. Because if it's just like a scratch or you don't really need to turn it into workers' comp, or if they need stitches. So, there's ways that you can help that process prior to turning things into your insurance company, eh, and hopefully it doesn't even get reported.
There are some
Great.
captive groups that are forming too, with smaller groups of contractors that pool their costs and their claims management together. If you'd like a one-on-one with our construction insurance team partner, I'd be happy to set that up.
Great. Thank you. And that's all for Q&A.
All right. Thank you so much, everyone, for joining us. So just as a reminder, if you go to our web page, you will see that we have these opportunities up and available for you to register for. So I'm going to just share in the chat again our link. So on the 18th, AE competition, Tishman will come on to talk about the casino in the Bronx. That is Bally's. Also on the next day, August 19th at 1 p.m., Surety Bond Associates will come on again and talk about how surety companies use financial statements and work in progress reports. So go on our webpage, register for that event. It'll be in 2 weeks. If you are in Western New York or interested in traveling to Western New York State Pop-Up Series will be having an event in person on the 17th of September. Registration is required. Chips and Bricks will be coming to Syracuse. This will be an Regional Opportunities Expo to talk about the many opportunities happening in Central New York. This will be on August 25th, and registration is required for that as well. So stay in the loop with Bid Ready. Watch our pre-recorded webinars. So everyone who comes on, we record and we share this on our webpage in addition to our YouTube channel. You can find all the links to that on our webpage. Feel free to visit us. If you have any more questions about BidReady generally, you can email us at bidready@esd.newyork.gov and stay in the loop. So thank you so much for staying on. Thank you so much. A special thank you to Surety Bond Associates for joining us today and for giving us this lovely webinar and the additional ones that they will be coming on too. Thank you so much, everybody. If you have any questions, feel free to email us.
Thanks, everyone.
Thank you.
See you next time.